Are you going to share that for us then?
Yeah, can you see it right now?
I can, yeah.
Okay, good. Uh, do you want, are you hearing an echo?
No,
Yeah, okay. So I don't hear
I mean,
it.
that's fine. We can just have you advance and we can just say advance if that's fine.
Yeah, that'll work just fine.
Do you hear that, Max?
Yep.
Okay.
All right, hey guys. Thanks for hanging in there for the exam. My goal is to get them graded tonight. If all goes well, I will. If not, they'll be graded by tomorrow, and I'll send them to you. And the next time we're in person, we'll go over the responses. Our plan for the rest of the evening is we're going to do a review of the week, and then I'm going to talk a little bit about one schedule change that I don't think will be a big issue for you. If you have an issue with schedule change, we'll talk about it because the schedule change is my doing. And talk about spring break and upcoming deliverables. And then we'll move into finishing up chapter 6, and that will wrap us up for the evening. So we're going to start with our review of the week with Max and Jordan going through the occurrences that happened.
Hey guys. So we're going to kind of break it down into the beginning of the week and then towards the end of the week. So if you looked at Monday, luckily it was President's Day, so all the markets were closed. One of the big things that kind of popped up on Monday was the fact that OPEC had reached an agreement to kind of decrease production of oil barrels. So what they're doing is the 10 OPEC nations are decreasing their production by about 80,000 barrels per day. It essentially drops their production down to a little under 30 million. Got so many things pulled up. 30.81 million barrels a day. So OPEC kind of uses the Brent crude global oil benchmark, and that was actually trading up. What they're trying to do is they're trying to push oil prices above $70 a barrel. Right now it's at about $66.33 on London's Intercontinental Exchange. West Texas, which kind of does futures here in the U.S., said they were up about 0.74% to about $56 a barrel on the New York Mercantile Exchange. Essentially, with this change in oil production through OPEC, what you're going to start to see is, variable costs are going to increase, costs of goods sold are going to increase, anything with plastic or anything like that, and it's probably going to go up a little bit, meaning that margins could be affected and cash on hand could be affected, looking at operational flow sheets. Moving forward, so there are kind of two things on Tuesday. BHP is a mining operation. It posted huge profits, which is kind of cool because with the current U.S. and China trade negotiations, they actually dumped one of their main shale operations that was actually in, I believe it was Arkansas. Sorry, so many pages up. Yeah, Arkansas for about $10 billion. Because they sold the shale operation plant, they actually had a lot more money to post into a dividend share. So looking at that, with a $10 billion sale of the operation, they posted another $1.02 per share coverage. So they actually paid that off as a dividend and didn't actually keep much as retained earnings, which was kind of interesting. So essentially they did a one-time boost, which was kind of fun and funky. You don't see many of that, at least I don't see many of that. Their main point for selling the shale operation was concerns over the change in tax rates in the U.S. during the China and U.S. trade negotiations. So what they are concerned about is, oil prices going out of the U.S., shale production being taxed at a higher rate or a lower rate because everything's kind of up in the air. They didn't want to leave too much of their assets open and vulnerable. So they decided to just kind of dump and switch operations over to Australia, which is kind of cool. The next big thing is Walmart beat the market. So Walmart actually saw a large increase in profit on the fourth quarter of 2018. So they just reported that on Wednesday. They actually were fueled by strong grocery sales, online orders, and holiday purchases. It's kind of funky the way they do their online orders though. So if you order online and you still show up at the store to pick it up, it counts as an online order. So what they're doing is they're trying to compete against Amazon at this point, and they're using kind of the online growth as being something to compete against Amazon when they're looking for investors. And looking at that, kind of the wiggle room they have there, well, technically the order was placed online, but it wasn't actually delivered through any delivery system. It was actually picked up in the store, so does that really honestly count as an online order? Walmart shares gains. Can we actually go to the next slide? Sorry about that. Awesome. So this is actually online Walmart's kind of market from last week. So this actually starts, after close. Since it wasn't open on Monday, this is closed on Friday. And then you saw this huge spike in their stock profit or stock offerings. Essentially, that was the them coming out and saying that we've made I think it was $1.2 billion more than they had last year, or 1.5. But it was actually pretty amazing for me to look at that and say there's a huge, kind of dramatic drop off. So that left some kind of wiggle room for investors to actually make a pretty penny in a really short period of time. So like I said, profits jumped from 3.69 billion from the 2.18 billion from the last quarter in 2017. It was a 2.2% gain. Where's my other piece of paper? And it was the thing was kind of interesting simply because this previous holiday kind of retail market said it was the largest drop in sales since the housing crash in 2009. So even with that huge drop in spending, Walmart was still able to turn a kind of a pretty penny and float itself through onto the next year. I think Jordan wanted to touch briefly on Wayfair.
Hold on, Max, before you go on
Yeah.
Walmart. So if you ordered online and picked up in store, that counted as part of their 40-some% increase in online.
Correct. So they're forecasting about a 35% growth in their online sales, but they said it's going to be a very slow growth. And I think part of that has to do with how they're accounting for online orders themselves. So if you're anything like me, I hate going in and waiting in lines for anything whatsoever. So I would definitely be, one of those people placing the order online and then just showing up and picking it up at the front desk as opposed to walking through the stores and waiting at checkout. Amazon doesn't have anything that can even compete with that. So it's kind of an interesting little niche. You can't really go to their, kind of delivery centers and pick up your packages.
You must not have ordered anything at Walmart at Christmas time because I did.
I'm a Target guy, 100%.
They did this thing where they set up sofas up in the front of the store, and you went in and you checked in there. You had to wait for somebody to come up. You could sit on the sofa while they went to the back of the store to find your order if it was a bigger item, and then come all the way back to the front. It was incredibly inefficient, and I did it one time and never
They
again.
didn't have Starbucks to offer you. It's horrible.
Did they break down? I just saw the 43% increase in online. Did they break down what percentage was truly online, where you ordered online and it was delivered, versus the percentage that was ordered online and picked up in the store?
They actually, so in the Wall Street Journal article that I found, they actually didn't break that down.
Yeah, I didn't see it either.
Yeah, so it's just kind of interesting, and I think that's something that they're not going to exactly be, advertising as much because they can still use the online, the way they're calculating it to compete against, the delivery stores. So I think what they're trying to do is niche into that market, even though they don't have a, viable way to do that at this point. Although I think they just did develop it was like an online membership where Walmart's supposed to do free delivery, which is supposed to be kind of cool, and I think that's supposed to help boost their online presence as well.
Yeah, so kind of moving into Wayfair here, kind of just piggyback. I found this article a little later on in the week here, but kind of just piggybacks on that same Walmart story here, where Wayfair, which is an online furniture retailer, had better than expected fourth quarter earnings, and their stock price jumped 30%, which I found kind of interesting. That it was actually the first quarter that they've been profitable. So they had a huge jump in their price there. We can go ahead and move forward another slide here too. So as the week progressed on here, I found a couple of stories that I found interesting. One was I'm not sure how many of you are basketball fans and specifically ACC fans, but this guy Zion Williamson from Duke is like the next LeBron James apparently. And on Thursday's game between Duke and UNC, just a couple seconds into the game, he rips through his Nike shoe, and the very next day, Nike stock loses 1.1 billion in market cap. So I kind of found that very interesting that a college athlete who's not getting paid for the Nike shoe that he's wearing, the school is, happened to, blow out this shoe while he's in a match, and Nike, as an entity, lost $1 billion in market cap because of this. So I wanted to kind of pose a question out there to anybody in the class. Can anybody else think of a high-profile, athlete that's had an equipment failure that's led to such a dramatic loss in a stock's market cap? I can think of one. I was just hoping anybody else can throw me a bone here.
Which sport?
Anything.
No, but which is the one you can think of?
Golf.
Oh, when Tiger switched to clubs?
Yeah.
Yeah. Also Nike.
Yes. All right, well, moving on. I thought I'd give it a try. So another big news here on Friday. So Kraft Heinz, I guess it's a merger between the two, ended up having to write off about $15 billion worth of bad investments and bad investments. They had a dividend cut and projected their guidance down by roughly half in the upcoming year. So the analysts say that Kraft has a serious balance sheet problem. Hopefully I'll get a little more participation on this one than the last one, but can anybody give me a reason or think of anything as to why Kraft would have a serious balance sheet problem?
Jordan, feel free to call on somebody. We just took a midterm. We should have answers on this one.
All right, I'm dying here. I did too. I was hoping to get some participation. Anybody throw me a bone here? I've helped all of you guys out on all these. We gotta see Jacob.
Yeah, I'm not too familiar with Heinz, but I think either last year or 2 years ago, didn't they spend a whole lot of money on potential investments that fell through, and they didn't pan out for them? And I'm not sure exactly how that affected their financial statements, but I did know that it was kind of there was a lot of press around it because it could have been huge for them, and it fell through and it didn't work out. So I don't know if that's one of the reasons, but
Yeah, they did go through a big cost-cutting measure. Jamie?
I don't know how many acquisitions they've done, but perhaps like they are taking an impairment on their acquisition, so where they could have overvalued it and then it didn't come to fruition over like whatever their projected growth that they signed up to deliver through the acquisition model could create impairment.
Okay. Anyone else? Professor, you have any ideas?
I might have a couple. This was a good one because Kraft Heinz, you combined several companies that had big name brand products. This occurred at the same time that we saw a real move away from packaged goods. People are eating at home, but they're using more fresh ingredients. They're using more of the Blue Apron kinds of products as well. And so Kraft macaroni and cheese isn't what it used to be in terms of a staple in people's pantries. And so the merger occurred. They overpaid for a merger, which they typically do. It occurred at the same time that we started to see a decline in demand for some of these products. What Kraft Heinz did is they, as often occurs with a merger when you have a lot of debt, is they attempted to reduce debt by cutting costs and by not advertising as much at exactly the wrong time. So this write-off is to write off the value of a lot of their brands because they've deteriorated so much as a result of really poor decisions on the part of Kraft Heinz. And you may recall that Berkshire Hathaway owns a good share of Kraft Heinz, I think in excess of 25% of the company. they don't typically like companies that have write-offs. So Kraft Heinz should be concerned about Berkshire's departure and begin to sell off their position, which would not be good, because it doesn't look like there's a turnaround in sight right now. We have less demand for packaged goods, and we have a company that has mismanaged its acquisition. So not a good sign, and deservedly written off. I think there's also an SEC investigation that's causing it to decline. So a series of things are struggling. My guess is you'll start to see this company disaggregate, and you'll see them sell off pieces of the brand.
Yeah, and finally here, as the week ended here, we have another article I think was mentioned last week that the U.S.-China trade talks are ramping up and coming to actually a kind of a head, if you will. The largest or most complicated parts of these trade talks, where we talk about intellectual property and things of that nature, which haven't been talked about yet, which are the real sticking points, are coming up. So there's been a lot of talk about, there's a lot of positive movement going on, but they've been talking about a whole bunch of silly things, like they just agreed to 10 million metric tons of soybeans, which is a lot of soybeans to buy from the United States. But, intellectual property theft and things around that nature are really where this deal is going to either come to fruition or die. We can go ahead and move forward.
I didn't hear you. Say that again.
We can go ahead and move to the next slide. Then this is just, we wanted to kind of do this a little differently than groups in the past. We kind of waited till the end. So overall, between last Friday and this Friday, each one of the markets went up about 1% respectively. So it's just a 5-day graph of these, each individual market. But week in to week out, about a 1% gain across the board between S&P, the NASDAQ, and the Dow Jones. We can go ahead and move to the final slide. Oh, and yeah, so what to watch for next week? Again, the important portions of the U.S.-China trade talks. So Reddit co-founder, Alexis, I guess his name is Ohanian, has said that social media has reached its peak. So I found that interesting in terms of like Facebook's, Instagram, Snaps out there, where they're saying that the pervasiveness and the ability for social media to actually influence and reach consumers, he's saying it's at a peak. So that's an interesting kind of trend to kind of see where those types of stocks and that type of industry is heading. Another interesting thing here, federal student debt is up to 1.4 trillion. In comparison, during the 2008 financial crisis, so in about 2023, there's going to be about a 40% expected default rate on that student debt. And to put that in comparison to the 2008 financial crisis, mortgage delinquencies and defaults were only at 11.5%. And we saw how destructive that was. We're talking about 40% default rate on $1.4 trillion in debt there. Again, the kind of the Trump-U.S. trade talks, they're slated to meet as
Don't move off that student debt. Okay, look at what's occurred. So we have a massively higher default rate. Student debt is up 100% since the recession. So it used to be 30. I didn't see the per student figures, but it used to be about $30,000 in debt when you graduate. It's up to 100%. You've got to be expecting that the debt levels are up north of 50,000 at least. And look at what that also does. That slows down the ability to buy automobiles, buy houses, savings. All of these things are impacted by all of that student loan debt. And so this is a big one. This was really, really bad news when that piece of information came out. Okay, now you can move on.
Okay, so again, more news on the Trump and China's leader, Xi's slated to meet at his Mar-a-Lago estate. I still don't believe any of that's going to happen, but beyond that, companies coming up to report, you can see over here on the right, Home Depot, Best Buy, Campbell's Soup, Lowe's, HP, and Dell. The Home Depot and Lowe's are particularly important because they kind of detail housing, construction kind of type events. So if Home Depot and Lowe's, end up turning negative earnings, and means people aren't buying the those types of goods that kind of create other jobs as well. And then, as we kind of touched on before, Warren Buffett issues his annual report this past weekend. He's most likely going to have something about Heinz in there, probably something not very nice about Heinz. But people watch this, investors and those types watch this pretty heavily to find out what his company, Berkshire Hathaway, is going to be investing in for the next year.
One more thing as well. So on Wednesday, there was an article about Lyft actually being able to post their first IPO. So that's supposed to be coming up in the next week. What they found is that the SEC is actually pushing through IPOs at an accelerated rate due to the shutdown that occurred for a couple weeks. So Lyft is actually going to be the first ride-sharing app to be publicly traded on the NASDAQ. So that should be kind of fun, looking forward to.
Okay, we're good. Any questions, comments?
Okay, I have a couple of things I want to talk about. So let's see, over here. You hit most of the stories I had that I wanted to cover. One of the things we're starting to see is the market's feeling a little bit more favorable. Again, if you look at any of the technical analysis, typically when the market is up the first 2 months of the year, it means 65% of the time it's up for the rest of the year. So it's a good indicator. But a more important indicator is the earnings announcements have been better than expected. The Fed slowed down interest rate increases. Inflation's pretty under control right now. The one thing though is wages have not been increasing as quickly as they should, given what a tight labor market we have right now. The unemployment rates are so low. So you should start seeing wages increase. And as that occurs, you might see inflation pick up and the economy slow down a little bit. But in general, things are looking really good. We're less worried about the China trade talks. That's all kind of calming down. The tariffs are calming down. So all of those are really positive signs. Let's see, a couple other things I wanted to mention. Oh, the FANG stocks. What are the FANG stocks? Do you know any of them? Facebook, Apple, Amazon, Netflix, Google, Alphabet. Those stocks have done well. They've bounced back from December when most of them did poorly, but only I think Facebook and Netflix have outpaced the increase in the S&P, and this is actually viewed as a good sign. It's viewed that the market recovery is more broad-based, whereas last year in the fourth quarter, a lot of the growth in the market was attributed to the FANGs. They were driving about 9% of the total growth in the market. And so now a broader based acceleration in the economy is a good indicator that it's not just concentrated in a few firms. In addition to Lyft going public, you're also looking at Pinterest going public. And Pinterest started out as, a place to look at crafts and recipes, but it's become one of the top search engines now. And I think I saw the number is 15 billion. And as Max just noted, their SEC, after stalling on IPOs because it was the government shutdown, they now are accelerating things. And IPOs occur in sort of bunches based on, and ordinarily is a signal that people are expecting the market to continue to do well. So watch the IPO market as we move along. And Berkshire Hathaway, he did release his letter. It's about an 8-page letter. When I lived in Kansas City, I used to take students up to the annual meeting. I've owned his stock for years. And so shareholders are allowed to go to the meeting. So I used to take students up, and it's an incredible lesson. The one thing that I noticed in his letter today that I thought would be very relevant for you all, he said to start focus on operating earnings and ignore bottom line, because the changes in the tax structure have caused wild swings in Berkshire's bottom line. Part of it is because he's got a lot of insurance and reinsurance companies in there. But again, what's important? Operating earnings, which is as close to cash flows as you can get. It's not unusual for Berkshire to be more focused in that direction. All right, anybody else have anything else they'd like to add about the markets? No hands. Okay. All right. If you would, while I'm talking, go ahead and fill out the survey for Jordan and Max. I sent it to you in the email earlier today. There was a link to get to the survey. So if you would fill that out. And meanwhile, I'll pop back over to Zoom here. Good. Okay. I'll give you a minute to fill that out, and then I'll start talking about what's to come. It's pretty good. I think this is the first time in either class I've remembered to say do the survey. So we're halfway through the semester. I'm getting there. All right. I'm going to send you an email with all of this in. So if you're still writing, don't worry about listening to me too much. You're going to get an email. So next week we're on spring break. We do not have class next Monday. The following week, March 11th, we're in person and we're going to be doing chapter 9. Okay, that's NPV. You already know part of NPV. This is a great chapter because it's all of the different tools that we have in order to evaluate projects to see if should we buy another company, should we go public, should we build a new factory. So we're going to look at NPV and IRR and other decision tools and talk about when we use them and when we don't, and do lots of problems in chapter 9. So that's occurring. And then on March 18th, the Rosetta case is due. Now you have everything you need for Rosetta case. It's posted online. You don't have to buy anything. I wrote it. It's posted there. The questions that you're supposed to answer as you do the Rosetta case are posted there as well. Now you're doing a case analysis. What I don't like is question number 1, respond. Question number 2, respond. It's a case analysis, so you should be focused on writing it up as a typical case analysis. So it's due March 18th, but you're ready to start on any point in time, so get it over with as quickly as you can. Now, we're doing that case first, and then in April, I'm going to bring in one or two of the execs from Rosetta to present and talk to you about where the company is now and where they're going. And then you're going to do an oral presentation based on Rosetta at the end of the semester. The speaker had to switch dates. He was supposed to come to your class April 8th, I believe. Let me find your syllabus because I wrote it all out there. I think he was supposed to come like April 8th, and he had to move it. Yeah, that was it. And he had to move it to the 15th. And when we moved it to the 15th, the final deliverable was due on the 22nd, and that was just too quick. I wanted you to have more time than that. So the way the schedule says right now is April 29th was supposed to be an asynchronous class. I'm changing that. We're going to be in person. So the date for Rosetta is still due March 18th, is a individual written case analysis on the Rosetta case that's posted. And then on April 15th, we're going to have one or more executives from Rosetta come in and talk about the company. And then on April 29th, syllabus currently says it's asynchronous. It is not. It's in person, and you're going to do your presentations that night. So the due date for your presentations moved from the 22nd to the 29th, just to give you a little bit more time based on the speaker's availability. Any questions on any of that? Sound reasonable? Okay. That's it for my announcements. And as I said, I'm going to send you an email. Probably after I grade, I'll send you the email that includes an update on the test and how you did. I'll send you a separate email with your individual results, and then I'll also give you an update on this content. Rebecca?
So the 22nd, it says Rosetta strategy due.
Yes.
Is that
no. It'll be due the 29th.
Okay, and the presentation is also the 29th.
That's correct. And
okay.
what is actually due is just your PowerPoint presentation, and then you're going to present it on the 29th. In
okay.
your team, you're not going to have to do a written analysis. You're just going to do your PowerPoint.
Okay.
Okay. Good question. Anybody else? All right. Well, let's wrap up chapter 6. You guys are nearly done with it. There's only a couple of quick things to do here. All right, so the first question is, oops. So if we had a 5-year interest-only loan with a 7% interest rate, principal amount is $10,000, interest is paid annually, what does this look like? Well, if for interest-only loans, if it's a 7% interest loan, that means 7% of $10,000 or $700 is due every year, and then that's all you get every year. So interest-only, you just get the $700 each year until the last year. And the last year, you get your $700 plus you get the $10,000 back. And we'll see, we're going to do a lot of this valuation. I think that's chapter 7. And that's how we value a bond. And so we'll see exactly how to do this calculation. But as you're sitting there thinking, you should be thinking, okay, so what would I pay for that investment? Well, $700, the exact same amount every year, that's a payment. And the $10,000 that I get at the last year, that's a future value. So we are going to be able to value these really easily. Now, there's other types of payments too. For individuals, for us, if we have a mortgage, how do we pay our mortgage? Well, we typically pay the exact same dollar amount every month. And in the early years of our mortgage, the bulk of the payment is interest payments, and over time we shift from mainly interest payments to mainly principal payments. So, but in the last couple of payments, it's almost all principal repayment. We do that because it's easy. It allows us to have the exact same dollar amount every month that we owe, and as a result, it's easier for budgeting. Companies typically don't do that. Companies typically have a fixed principal repayment, so they sort of retire a fixed amount of the principal every period, and then they also pay interest every period, and more interest in the early days, less later on, and so their payments are larger in the early days and they decline over time. So if we have a $50,000 loan that's for 10 years with 8% interest, and they require us to pay $5,000 in principal each year plus interest, what would that look like? Well, I did it in Excel, but I'll show you here. Okay, so I'll post this later so you have a copy of this in Excel. So the principal, which I misspelled there, that's interesting. Principal is AL. So the principal repayment is $5,000 each year, and so that's not going to change. This number stays the same all 10 years. So by the end of the 10th year, we've paid down all $50,000. What changes is the interest. So initially, I owe $50,000. 8% interest of $50,000 is $4,000 in interest. And then so my total payment is $9,000. Whoops, that wasn't intended. My total payment is $9,000. The $5,000. Sorry, my drawing tool's not working very well. So the $5,000 that I have in principal retirement plus the $4,000 in interest. So altogether, I'm paying $9,000. Started out with $50,000 in principal that I owed. I paid down $5,000 of it, so what remains is $45,000. That interest is purely just interest expense. The principal amount is how much I'm repaying on the initial $50,000 debt. So in the next year, I owe $45,000. I'm going to pay $5,000 in principal. 8% of $45,000 means I'm paying $3,600 in interest. So my total payment went from $9,000 in year 1 down to $8,600 in year 2. By the end of year 2, I've cut another $5,000 off the amount that I owe, so I only owe $40,000. And we go down, and this is an amortization table where we have a set principal amount. Okay, this is great for companies. It's the way they typically work, but for us, it's a little different. So here we have a more standard payment where our interest expense is included and we have a fixed dollar amount payment. So if we have a 4-year loan with annual payments, interest rate's 8% and the principal amount that's due is $5,000, what's our annual payment? I'm not going to put you into the rooms, but go ahead and take a minute and do this calculation. So we're trying to find the payment on this particular loan. And when you have an answer, if you would raise your hand. You can do it electronically too, Max. Thanks. Give everybody 1 more minute to see if they come up with an answer. Okay, Rebecca, what did you get? Turn on your mic. Thank you.
I didn't get it. I don't know.
Oh, okay. Hold on. Mike Cook, what'd you get?
$1,509.60.
Good. How did you do that?
Well, I just did the payment function in Excel using 8% interest, 4-year period, and then a negative $5,000 PV.
Good. So what Mike did is he used the payment function in Excel with our NPER is 4 years. My interest rate would be 8%, and the present value is 5,000. So when you compute the payment, you should get 1509.60. Anybody have any questions on how we did that? Okay. In year 1, we started out with a principal amount of $5,000. 8% interest on that is $400 of interest. So of that 1509 that we're paying, 400 is interest. So only 1109.60 goes for retiring the debt. With that 1109.60 retiring the debt, it means at the end of the first year we owe 3890.4. Okay, Mike, do you have another question, or is that your hand from earlier?
I was just trying to figure out how to lower it. I'm good.
Oh, okay, good. Okay, thanks. Okay, so so at the end of year 1, of that 5,000, we still owe 3890. So in year 2, 8% of 3890 means I have interest of 311.23. I'm still paying 1509. So the difference between the 1509 and the 311 is about $1,200 is how much more I'm reducing. So my 3890 principal less that about $1,200 means at the end of year 2, I'm down to owing $26.92. Okay. And we continue on. So by the end of year 3, we owe $13.97. The end of year 4, we make our final payment. Let me show this to you in Excel so you can see what it looks like, what an amortization table looks like. Sure you can see it. As I said, I'm posting this later on. So here's the table. We start out having principal of 5,000. We have our set payment. Our interest is calculated at 8% of the remaining principal. So at the end of the first year, we're down to 3890. And you can see what happens through time is that our payment stays stable. Our interest amount declines over time, and our amount of principal that we're repaying thus has the amount of principal in each payment increases over time and interest decreases. To me, amortization tables are accounting focused, and you'll never see one again in any finance class. But in the real world, you do see these. If you're looking at acquiring a large asset, you'll look at the payment structure and the pay down on the asset. You often look to see if there's prepayment penalties and such. But for the most part, you won't see them again in here. In other words, you don't get tested on them. But it's nice to have a sense for what one looks like. Any questions on an amortization table? You okay? Okay. Let's pop in. I've got 2 last problems I want you to work before we wrap up tonight. Make sure I get to the right spot. Just did. Here's one. Okay. Now, oops, sorry. Okay. Here we have some cash flows. And we have 3 different discount rates. So I want you to calculate the present value for each of, for these cash flows using the 3 different discount rates. And I'll pop you in your room so you can do these together, and then we'll come back together and see how you did. Your room should be open. It should only take you a minute or 2. If you don't have this written down, go ahead and take a quick picture of it so that you're able to work the problem in your room.
$5. And for 25%, we got $2,632.96.
Okay, Jamie, tell everybody how you did that problem.
Sure. So I put it in Excel for each of the years, and then I did the NPV formula. So I did NPV 7%, comma, and then highlighted all of the cash flow. And then I did the same thing for each of the other ones, just updating that rate portion of the formula.
Okay, so Jamie used the NPV function in Excel. You could just put a rate in and keep changing the rates, or you could do the formula 3 different times. So when you do the NPV formula at 7%, you get 39.26. 17, it drops. You're discounting at a higher rate, so the amount you'd have to invest today in order to generate those cash flows in the future will be less, and then even less at 25%. Does anybody have questions on this one or want to see it in Excel? I'm pretty okay on that one. Okay, let me have you do one last problem, and this one has different time periods. So we've got $5,100 per year for 10 years. Figure out what it's worth in today's dollars at a 5% rate. If it's 10 years, what if it's 35 years, and what if it's 65 years? So I'm going to open your breakout rooms, just check your work quickly, and then come on back, and we will see how you did.
Guys, but basically, if you do it in Excel, because I know what most people are using. So for the first one, you would, you put your years 1 through 10, and then put a payment of $5,100 in each one of those years. Your rate is 5%, and then you would just use the NPV equals NPV 5%, and then highlight those 10 $5,100 payments. Press enter, and you get 39,380.85 for the first one. And
Okay.
for 35 years, so you basically do the same exact thing, but for 35 years or 65 years. So for 35 years, you get $3,508.39. And for 65 years, you get $97,721.46.
Okay, good. So Tom used the NPV function and wrote out 10 years worth of numbers, 35 years, and 65 years worth of numbers. Emily, did you do it a different way?
Did not. I've been trying to flip through the books. I feel like there's got to be something else.
Okay. Anybody else do it differently and not use the NPV function? Mallory, what'd you do? Mallory, what did you do?
Sorry, we just used regular present value. So just did present value 5%, 10 years, negative 5,100, and then present value 5%, 35 years, negative 5,100, and so on.
Yeah, what Tom did is perfectly fine. But you've got an easier version here because it's the exact same amount every period. So your payment's $5,100. First, you put NPER at 10 and a 5% rate and calculate the present value. And then if you change it to 35 years, it changes the present value. And if you change it to 65 years, it changes the present value again. So it's perfectly fine to do an NPV function, but because it's the exact same dollar amount, it's also just fine to use the payment function. Any questions on that one?
I actually also used the calculator, and that worked out really well too.
Yeah,
that was much faster.
Good. Use the cash flow
But
button.
now I just did it the way. Yeah, but I just looked at what you just said, and that makes a lot more sense.
Yeah, well,
I was just trying to do it fast
yeah, well,
and not really thinking, I guess.
doesn't matter. You did the exact same thing. I mean, your answer was right. It just, you had to write out all those numbers versus with the exact same dollar amount, you don't have to do that. All right. Any questions wrapping up chapter?
Yeah.
You guys are good. Okay. So enjoy spring break next week. If you travel, I think some of you are traveling. So enjoy Chile or wherever your travels take you. And then I'll see you in person on the 11th, ready to do chapter 9, which is one of my favorite chapters. So I'm glad we're in person for that one. You guys have a great break, and I'll see you in 2 weeks. Bye, guys.
Thank you.
Hey,
Take care.
thank you.
Have a great night.
You too.